In the world of high finance, the cardinal rule is simple: never lose capital. But what happens when the second most powerful nation on earth decides to shatter that rule deliberately? China has just jettisoned $688 billion in US debt holdings. But here's the seismic twist. They did not sell for profit. They sold at a historical, bleeding loss. The mainstream consensus labels this a strategic realignment. We diagnose it for what it truly is: a system-wide fire alarm. You do not liquidate your primary assets at half their valuation unless you smell the smoke before the masses see the fire. China is not negotiating. They are executing an immediate evacuation. This is the intelligence briefing you need. This is macro threshold, and this is the era of collapse. The critical inquiry remains: what systemic contagion are they anticipating that remains invisible to you? This unprecedented action taken by Beijing demands a frigid, data-driven postmortem, stripping away the political rhetoric to examine only the raw numbers. Fear is not merely justified. It is necessitated by the data we are about to present. This is the geopolitical intelligence relied upon by the financial elite, and it begins with understanding the true cost of this extreme liquidation. China is absorbing a monumental financial impairment, a self-inflicted wound, calculated simply to purge this paper from its balance sheet as rapidly as humanly possible. This is not a common Treasury transaction. It is the opening salvo in what we are defining as the war of distrust. When a nation intentionally sets fire to its own reserves, it signals a complete lack of faith in the underlying asset, and more dangerously, in the issuer. The resulting psychological shockwave is not contained. It is reverberating right now throughout the global sovereign bond market. Every major financial institution watching this move, from Tokyo to Frankfurt, is performing a real-time risk assessment, asking if they should be next to evacuate. The central issue is the sudden and severe erosion of sovereign confidence. This move declares to the world that China believes its assets are safer outside the jurisdiction of the dollar than inside it, regardless of the immediate financial pain. To accurately measure the potential for global catastrophe, we must look to historical precedents, those critical junctures where major institutions dumped strategic assets at fire sale prices, signaling either systemic panic or the initiation of economic warfare. These examples confirm that liquidating assets at a loss is never a move made lightly. It is a desperate tactical decision born from superior, often undisclosed intelligence. We see the first powerful parallel in the UK Treasury's notorious gold dumping. Between 1999 and 2002, the UK liquidated nearly 400 tons of gold, not only hitting the market at historical lows, but absorbing massive losses, crippling the value of its remaining reserves. This move signaled a profound crisis of sterling confidence at the time, prioritizing liquidity and a theoretical move away from barbarous relics just before gold began its 20-year bull run. The second, and perhaps most terrifying precedent, occurred just prior to the systemic shock of 2008. We are referring to the mass liquidation of mortgage-backed securities by banking insiders in late 2006 and throughout 2007. They were the first to understand the toxic architecture underlying the housing market, quietly purging their balance sheets at significant discounts before the public even registered the first tremors of the subprime meltdown. Their losses were the calculated cost of avoiding total insolvency when the market finally corrected. The final critical example is Russia's accelerated de-dollarization strategy following the 2014 sanctions. Moscow systematically and rapidly purged US dollar holdings, prioritizing national security and resilience over maximizing yield or profit, understanding that holding dollar assets made them vulnerable to weaponization. In each of these three cases, the institution making the sacrifice possessed superior intelligence, choosing a guaranteed loss today to avoid a catastrophic, total loss tomorrow. China A's current action shares the DNA of all three. It is a calculated flight from toxic exposure, executed by those who possess superior information regarding the fragility of the financial superstructure. The immediate triage report confirms that fear is warranted. The current macroeconomic data actively validates Beijing's risky decision. If China is exiting the US debt market with such violent speed, absorbing hundreds of billions in losses, what specific indicators justify this unprecedented cost absorption? The primary justification is the persistent inflationary regime gripping the US economy. US debt holdings, denominated in a dollar constantly losing real purchasing power due to sustained inflation, are experiencing continuous erosion of their true value. Holding these bonds means accepting a negative real yield, a guaranteed pathway to capital destruction. Secondly, we observe the deeply inverted yield curve. This anomaly, where short-term borrowing costs exceed long-term yields, is historically the single most reliable predictor of an impending recession. In fact, this current inversion is widely considered the most forecasted recession in modern history. confirming a deep systemic risk aversion that justifies China's immediate flight to safety before the inevitable economic contraction. Thirdly, we must address the surge in the DXY index, the measure of the dollar to RS strength against a basket of currencies. This strength is frequently cited by optimists as a sign of U.S. resilience, but we interpret it differently. The DXY surge is, in reality, masking underlying systemic economic fragility. It is a manufactured artificial strength driven by the global shortage of dollars, which is itself a precursor to massive liquidity crises. When a central bank is actively fighting inflation with record rates, the carrying cost of that nation's debt becomes explosive, regardless of the relative strength of its currency. China recognizes that the supposed safety of the dollar is a mirage built on historically unsustainable debt levels. If China is correct, and if other major sovereign holders, Japan, the UK, Saudi Arabia, recognize the intelligence and choose to follow Beijing's lead, the resulting domino effect would initiate a catastrophic collapse timeline for the U.S. fiscal structure. The first phase of this critical timeline is the buyer strike. If the largest buyers of U.S. debt liquidate, the U.S. Treasury would find itself without its primary source of funding for its rolling deficits. To attract even marginal buyers, the Treasury would be forced to dramatically escalate interest rates, offering premium yields far above current levels. This escalation is a mechanism of desperation that shifts the burden of debt financing entirely onto the domestic economy. The second S, the explosion of debt servicing costs. As new debt is issued at dramatically higher rates, the interest payments on the existing and newly refinanced national debt would immediately become the single largest expenditure line item in the federal fiscal budget, crushing all other discretionary spending, including defense infrastructure and social programs. This is the financial definition of gridlock and guaranteed fiscal insolvency. The third, and final, involves the massive capital flight from risk assets. As borrowing costs spike across the entire economy, equity markets are immediately punished. Corporations cannot afford to borrow, economic activity freezes, and the rapid contraction triggers widespread margin calls across leveraged institutions, initiating a deflationary spiral within the real economy. China's loss today is not a mistake. It is the calculated cost of opportunity. The decision by China, therefore, is the calculated cost of opportunity to avoid the total systemic implosion they foresee. But this leads us to the critical final inquiry, the one that truly defines our position on the front line. Is Beijing correct to execute this massive, costly evacuation, or is this a grave strategic miscalculation that ultimately weakens their global standing? This question divides analysts into two camps, and understanding both sides is vital to navigating the volatility this action guarantees. The first camp, those who defend Beijing's radical move, see this not as an act of panic, but as preemptive financial warfare, prioritizing national stability and long-term geopolitical maneuverability over immediate paper profits. For this group, the $688 billion loss is the premium paid for insurance against two catastrophic scenarios. First, the guaranteed erosion of debt value due to America's persistent structural inflationary regime. And second, the future weaponization of the dollar, similar to the sanctions imposed on Russia post-2014. By purging this massive block of debt, China reduces its exposure to the erratic monetary policy cycles emanating from the Federal Reserve and simultaneously dismantles a portion of the financial leverage Washington holds over them. They are sacrificing capital today to ensure the ability to conduct global trade tomorrow without reliance on the U.S. Treasury architecture. They recognize that if the U.S. Congress continues to engage in high-stakes brinkmanship over the debt ceiling, the confidence game on underpinning the dollar's supremacy will eventually shatter. Beijing simply chose to exit the table before the final hand is played, absorbing a known calculable loss rather than facing the potential of a total loss scenario in a hyperinflationary environment, or through seizure risk. The defense argues that securing their national balance sheet against the inevitable fiscal insolvency of the United States is the primary non-negotiable directive, making this painful liquidation profoundly rational. However, the second camp views this action through a lens of profound weakness and strategic failure. The critics argue that this dramatic liquidation is not an act of strength, but a necessary evil driven by internal desperation, primarily linked to managing the fallout from their own catastrophic property crisis and the need for liquidity to prop up domestic provincial banks. This view suggests China is not leading the world away from U.S. debt. Rather, they are the first domino forced to sell because their internal economy is cracking under the pressure of demographic decline and the implosion of the residential housing market. Furthermore, liquidating this debt diminishes Beijing's primary source of leverage over Washington. The U.S. Treasury bond holdings were China's strategic nuclear option, the ability to destabilize the global financial system through a threatened mass sale. By executing the sale now at a loss, They expend this critical geopolitical ammunition, suggesting they have run out of diplomatic and economic options. The liquidation, in this interpretation, is merely a loud, desperate signal of capital flight from a nation prioritizing survival over influence, risking global reputational damage. By initiating a crisis of confidence, they may not have the reserves to fully withstand themselves. Macro threshold rejects the simplicity of both extremes. The truth is that the intent behind the liquidation is secondary to the undeniable consequence. Whether China sold out of strategic brilliance or internal duress, the practical effect on the sovereign debt market remains absolute. Beijing has functionally declared that the financial risks associated with holding U.S. long-duration debt far outweigh the minimal yields it offers. This is not just a commercial transaction. It is a structural abandonment of the U.S. Treasury market as the primary destination for surplus global capital. This abandonment is the structural damage Beijing intends to inflict, forcing the U.S. system to find marginal buyers in an increasingly hostile environment. It accelerates the global trend toward de-dollarization and bilateral trade agreements conducted in local currencies, bypassing the SWIFT system and the oversight of the Western financial infrastructure entirely. When the world's largest sovereign creditor publicly absorbs a massive calculated loss to avoid a perceived future catastrophe, the resulting psychological shockwave is not contained within the trading floors of New York and Shanghai. It permeates the decision-making matrices of every central bank and sovereign wealth fund around the globe. If China, with its sophisticated intelligence apparatus and long-term planning horizon, believes the financial architecture of the United States is fundamentally flawed, what justification do smaller, less resilient economies have for continuing to hold these instruments? The action validates the deep recessionary fears forecast by the inverted yield curve and confirms the catastrophic risk presented by America's unsustainable debt trajectory. For you, the investor on the front line, the intelligence derived from this event is stark and actionable. When the world's OS largest players are evacuating the primary safe haven asset, the U.S. Treasury, the concept of safety itself must be redefined. You must question every assumption predicated on the status quo of dollar dominance. The historical anchor that kept global finance steady is now demonstrably adrift. The core directive for the next economic cycle must be immediate and aggressive diversification away from assets that depend entirely on the continuity of the current sovereign confidence regime. This requires a radical shift in perspective. If China is right, the primary threats are not cyclical recessions, but permanent inflation and guaranteed currency debasement. Your portfolio defense must pivot towards genuine inflation hedges, scarce resources, hard assets, strategic commodities, and non-state dependent digital assets. The days of relying on the assumed safety of paper promises are ending. Capital preservation in the coming decade will rely not on yield, but on scarcity and sovereignty outside the reach of governmental fiat manipulation. The calculation is simple. If the U.S. government must eventually inflate away its debt obligations, a political necessity to avoid outright default, then fixed income assets, including sovereign bonds, are guaranteed to experience a continuous and fatal decline in real purchasing power. China simply got out early, swallowing the principal loss today to avoid the hyperinflationary haircut tomorrow. This is the intelligence briefing you required to understand the true cost of Beijing's divestment. This action is not noise. It is the loudest, clearest signal of geopolitical distrust the modern financial world has ever seen. The systemic contagion they are anticipating is nothing less than the eventual fracturing of the current global financial order. The consequences will be unpredictable, volatile, and immediate. The only defense is information and preparation. The $688 billion question is only the beginning of the structural transformation of global finance. We invite your analysis and perspective below. Does China's sacrifice validate your deepest concerns about the stability of the U.S. fiscal situation, or do you view this costly exit as a desperate political maneuver destined to backfire? Your insight is critical. We monitor these seismic shifts continuously, translating complex data into immediate, actionable intelligence. Ensure you remain connected to macro threshold. The next crisis is not coming. It is already being priced in by those who smell the smoke first. The time for passive observation is over.